Hi, everyone. This is Craig Zelzer back with our latest social change career podcast live stream. Today, we're talking with my friend Bethany Hull. We're on episode 9, season 14, and we'll be talking about innovative finance and impact, how to build an unconventional career. So, that is, I think most of the guests we have on the podcast, I think we're up to about 190, have not planned their careers. They've planned certain things, but a big part of an impact career is being open to the opportunities. For people who may not have joined us for a live stream before, this generally goes about 1 hour. We really enjoy hearing from people who are watching live, particularly on LinkedIn. So throughout the podcasts in LinkedIn comments or even YouTube, feel free to let us know where you're watching from, a bullet point or two about your work, and also questions, comments, and resources. This is one, I already said, about 190 episodes. So the audio version of this will be live on Friday. And you can find all the episodes at pcdn.global/listen, pcdn.global/listen, or any major podcasting platform. 3 quick requests before we get started. First is please follow Bethany on LinkedIn. Please follow PCDN, check out our newsletters. And then whether it's for this podcast or any podcast, the number one thing you can do for a podcaster, and for 99% of the podcasters in the world, it's a labor of love. There are some people who make a living at it, is rate and share it. So that's, whatever platform you listen on. So Bethany is an international finance professional with over 15 years of experience across sovereign debt, early stage venture capital, and impact investing. She has worked throughout Latin America. We actually met in Medellin, Colombia, where I'm based, in Asia, leading cross-functional teams and navigating complex projects in multilingual, multicultural contexts. She's a graduate of the Fletcher School Masters at Tufts University in International Business and is fluent in Mandarin, Spanish, and Portuguese, and passionate about using finance and entrepreneurship to support inclusive economic development. Again, I'm based in Medellin, Colombia. And Bethany, are you in DC or near DC?
Yes, I am. Well, I'm currently sitting in Bethesda, Maryland, but still in the DMV area.
So thank you so much for making time to share your wisdom, experience. And I know also I said at the beginning, please follow Bethany, but she shares tons of amazing resources and jobs and insights, and is also starting a Substack on impact careers, which we'll talk about. But first of all, when you think back to your teenage years, did you envision yourself working around finance and investment in business, or did you envision yourself being a doctor or a professor, or how in the world what led to this career path, or at least how did you get started in it?
That's such a good question. Thanks, Greg. I think it's one of the things that when I face uncertainty helps me stay feeling positive, because I grew up in a town of 6,000 in rural Missouri. So this is a very unusual career path. When I was a teenager, I was very, very serious about becoming a doctor. I actually did a prep program in high school, but I did envision a multinational career. I really wanted to work abroad from a very young age. And so that was always part of my goal. The finance and investment side, though, was a huge surprise. And I'm happy to talk about that a little more.
And then how did you transition? So let's say, when did you, if you were thinking about being a medical professional, you talked about multinational. So did you, in terms of undergrad, did you take a lot of classes in business? Did you have an amazing mentor, an aunt or an uncle? So when did you kind of decide to pivot some away from the focus on potentially medicine to something else?
Yes. So you said that a lot of the people on your podcast, they haven't had such I think none of us, no, I think no one has a linear career path unless you're going up the corporate ladder. But for me, I think I've had a lot of disruption and it shifted my path. And that started really young. So when I was in college, I had some family stuff happen that just really derailed my plans of going into medicine. And I also really wanted to study Arabic and work more in the humanitarian sector, but my college didn't have it. So I ended up studying Chinese, and I was really focused on getting into the foreign service or doing something with the State Department or the government and international affairs. And that didn't turn out to happen either. So the Peace Corps assignment that I got was the only assignment I wasn't interested in. And so many things happened. And so I ended up working in Taiwan for 2 years and supporting a CEO of an English language school chain in Asia. And I just kept finding myself drawn to finance. But I I really resisted it because it seemed so far out of the career path that I wanted for myself. And it wasn't until I landed at a startup that I really started embracing that and realized, like, no, this is something I have maybe both strong interest in and also acumen for. And that from there, I took one more job before grad school to really test that out. And then I was like, no, this is what I enjoy. I really want to do this. And so I focused on finance and entrepreneurship at Tufts. But it was, life really had to push me into it. I don't deviate from my plans very easily, which is maybe not the best thing actually, but yeah, life kind of shifted me in that direction. And to be honest, I'm really grateful.
And in terms, I mean, I studied French in high school and I hated every minute of it. Not French language, but I suffered, and I was convinced I could never learn a language. Eventually, once I went to live overseas, I realized I could learn a language, and I've learned several. Though every new language leads to an erosion of the previous language. But
That's
how
right.
in the world? How hard did you find Mandarin? And then when did you add in Spanish and Portuguese? And can you, especially Spanish and Portuguese, can you keep them separate?
Oh yeah, no, that's very difficult. I cannot. I can tell you that right off the bat. I've always loved languages from when I was really young. And I think, though, kind of similarly to you, which you're going to learn a lot about my personality, I guess, today, but I really was unhappy about I went into learning Chinese a bit unwillingly, to be honest, because I was very upset that I couldn't find a way to learn Arabic. But I worked really hard at it. And I will say it is a very, very tough language. It took me 5 to 7 years to master, and that includes 2 years in country plus 2 years working at a Chinese-owned business where I was using Mandarin daily. And when I was in college, my first semester, I was taking calculus, and I like math, but I'm not great at it. And I spent more time on Chinese than I did on calculus. So definitely a very hard language to learn. Spanish is a lot easier. I think as an American, we grew up hearing it a lot. My best friend when I was young was Mexican American, and Spanish was spoken in their house. I started learning. I still have a ways to go, though. You know that. I want to master the advanced grammar. Portuguese, I love. I really love Portuguese. It is difficult to maintain the distinction. And to your point, I found the more Spanish I learn, the more Portuguese I forget. So that's tough. Yeah.
It would be an interesting experiment. I mean, I'm sure there's some formula. I met a linguist once who spoke 18 languages fluently and was learning 6 more. And this was in Romania, and he had a theory that if kids learn 3 languages by the time they're 12, I don't remember, it's his theory that something stays open in their brains and it's much easier. But it would also be interesting to look at when you learn a new language, like which language you might already speak is less likely to be impacted, because Mandarin is so different.
Yes, that's right.
So you got interested in finance, or at least life made you interested in finance. I'll phrase it that
That's
way.
right.
And it sounds like you were resisting it. So at what point, I mean, obviously working in Taiwan, and were you working on business operations? Were you working on sales, marketing, chief of staff? Were you doing everything? And at what point did you talked about this realizing, or at least being pushed toward this might be an area of interest, but how did you make that decision well, first, how did you decide to go to grad school? That's a dilemma a lot of people face, and your advice for other people who might be thinking about grad school. So let's focus on that first.
Sure. Okay, so how did I decide to go to grad school? I think I always knew that I wanted to go to grad school. It was a really big goal of mine. I grew up in a family where both of my parents had some college but didn't finish, and then my mom went back to school when I was 11, and they really emphasized education. And I had backtracked. I knew that to have a kind of longer term career in this area, you do need a master's degree typically. So that was on my radar. Part of why I went to Taiwan to really boost my Chinese skills. As far as finance goes, I think this is gonna be really funny to you. So, and when I look back, it's quite funny to me, but I was doing everything. I was supporting the CEO and the executive office. So I was doing a lot of the typical like personal secretary type work, but also business operations, market entry, supporting publishing. I wrote a children's book, a graded English reader. I don't know where it's at today, but it's out there. But my boss had offshore holdings, and so I was getting the communication and talking to our accountant about that. And at that time, I had no idea what that meant, right? But I was just so fascinated. He explained some of the tax implications, and I'm like, that's crazy. This is way more interesting and complicated than what I thought it was. And so that started getting me interested in it. And then I like running businesses. I like the challenge of matching the strategy and the finance. And when I went to work at the startup, again, you just have a massive amount of work and responsibility across all areas. And so before I had even been trained at all in pro formas, I was essentially creating pro forma financial statements for a potential $20 million investment. And it just came really naturally to me because it's very logical, right? What's the market? What's going to happen? What are the numbers now? And it all made sense. And I think that's when I really realized, oh, I like this. And then I went and I intentionally took a job. Again, life kind of changed my course. I had some family stuff, so I moved back to the Midwest. But when I moved back, I intentionally took a job that would give me more exposure to finance. So I backstopped the financials and operations for an $80 million fundraising campaign. And that's when I really felt that that was the right path and that was the direction I would take when I went to grad school.
And then any advice for people who are exploring to grad or not to grad? Obviously each person's skill set is unique, their geographic location, potentially sectors they might go into, but when someone might be thinking about grad school, any advice about how to choose or what to look for in a program? And obviously, I actually did apply to Fletcher. I think I already had a master's from Central European. I had a master's already from Central European University. And I said, if they give me money, I go. I didn't get it. I think I got in. I don't remember, but I didn't get a fellowship, so I didn't want to do it. But just kind of your advice for people considering that type of upskilling.
Yes. I mean, in the US, it's such a huge decision, right? Because of the cost. And I have a couple pieces of advice. I think just to be perfectly transparent, because I think it's really important, I very unexpectedly inherited some money and was able to pay off my undergrad student debt. And I think that really freed me up to think about grad school because otherwise, just the burden is so overwhelming. Having said that, most American students will take on a significant amount of debt to go to graduate school in the US. And it does limit you. I mean, it limits your ability to work abroad. Sometimes it limits maybe what types of careers you can choose. And that was part of my later decision of what area to focus on once I was in graduate school. I was looking at the salaries and how to pay back my student debt. So I think that's a really serious consideration. And when I was looking at grad school and reading up on how to decide whether to go in the US or abroad, there were a lot of kind of cautionary tales of, well, if you go to school abroad, you won't build your networks in the US, and it might be harder it will definitely be harder if you want to come back and get jobs in this area. And for American students, I think that's often true, but the cost is increasing so fast that I think that considering brand name schools abroad is a really good idea. And if you stay and you build your career up to a certain level and then come back to the US, I've seen that work. I have a very good friend who did her graduate degree in Denmark when it was still free. She also was able to get a lot more hands-on experience in her field than she would have in the US because it's a smaller market. And then she successfully brought it back to New York. So it can be done. And I think that has become much more complicated, especially right now. But yeah, I think considering doing school abroad is always a good idea if you're concerned about finances.
So just to add two comments. So my parents paid for undergrad. I was very lucky. Not everybody has that. And then I did my master's at Central European University. I was already living in Central and Eastern Europe. For me, it's a terrific, amazing, brilliant institution. And I got a tuition scholarship, and I had money left over from a Fulbright fellowship. So to be able to do masters and not be stressed, and I worked on campus.
Mm-hmm.
And obviously, I've been a professor for many years, but I do think always weighing the cost, both time and financial cost, and is so frigging important, particularly in this challenging
Yeah.
time. And if you get a fellowship, then it's a time and disruption cost. If you are taking on, 60 to 80 to $100,000 or more in debt, that
Mm-hmm.
could be a good choice, but don't. Many people put more decision into buying a house or their life partner, if they have one, than thinking about debt. And there's also lots of fellowships out there. So look at fellowships, whether from institutions or Fulbright or Schwartzman or Rotary. There's so many out there. Um, so 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 you went to Tufts, and then as it's a great institution. Went to Fletcher, and as you came out, where did you land next? And was it happenstance? Was it planned? Did you develop a lot more financial skills, or just develop more understanding of the industry at Fletcher?
Mm-hmm. I definitely both. I think every time I've pursued higher education, it's really transformed my life in a positive way, and I don't think I'm unique in that. And particularly for me, because I had lived abroad twice before I went to Fletcher. I did a year volunteering in rural Thailand before college, and then I spent 2 years in Taiwan after college. So I had a broad experience. I had lived in a big city abroad, but actually, when I guess I had one job in Boston, so one job in a larger city in the U.S. prior to going to Fletcher. But I still had so much to learn, and I think that really is a wonderful thing about taking time out of your life to pursue education is you get to know what all the stuff that you don't know, and that helped me a lot. So for me, I learned about venture capital as an industry for the first time. The startup I worked at had been privately funded, so we were growing and under pressure, similar to a startup, but we weren't venture backed. So I learned about venture capital. I learned about private markets. I learned a ton from my mentor and favorite professor, Jacques, who also started the Master of International Business program. And so it really set me up well. I very intentionally looked for a job at the nexus of innovation and finance. And I was really, really happy in my first job out of Fletcher. I helped launch a corporate innovation consultancy, and I was running our corporate finance function as well. The only thing I will say is that I had a lot of encouragement, strong encouragement to go into the big consulting firms or to go into investment banking. And I resisted that a bit to do something that I felt was more aligned with who I was and also gave me a bit more work life balance because I was older when I went back to grad school. I was 28. So when I graduated, I was 30. When I look back, sometimes I wish I had taken some of that advice, maybe just to do a year in an investment banking to give me a stronger base in financial modeling and a bigger network. So I really loved that job. And then I ended up at Standard Chartered Bank after that. So it didn't derail my career path, but so sometimes I think about that, like maybe that would have been a good thing to do, but you can never know, right? So.
And for people who may not know, I mean, there's lots of shows about venture capital.
Oh, that's right. Yeah.
If people watch Billions on Showtime, or there's a lot of there's Shark Tank that's more
That's
startup
right.
or angel investing. But what in the world is venture capital for someone who may knows the term but doesn't understand it? Who are venture capitalists, and what is the ecosystem all about?
Sure. So venture capital, which I think is going to undergo a revolution or a transition in the next 10 to 15 years. But venture capital has been around a long time, but I think it really took off in the 80s. So it's basically a type of fund that specifically funds high risk startups. And in the beginning, it was primarily funding tech based software as a service models, which is still mostly tech startups that are getting funded by venture capital. And the investors into the fund are high net worth individuals, public pension funds, university endowments, and venture capital took off even more once institutional capital started flowing in. And the reason behind that is that there was a CIO, a chief investment officer at Yale, who piloted this model and said, I think that private equity, which is a slightly different kind of business, focus more on mid-size company turnarounds, and venture capital can add a lot to our returns. And once that he had proven out that model, then all the other institutional investors all of a sudden got really interested. I'm wondering if we've seen this with private credit. Sorry, not to go on too big of a tangent. I think it'll be interesting to see if we see this with revenue-based financing, which is an alternative way of financing new businesses. But yeah, so that's kind of how venture capital developed, and it invests in early stage, mid stage, and late stage startups, primarily tech-based startups.
And to compare it to a loan from a bank or friends and family, so a loan from a bank, it depends on the country, but maybe the bank is making 7 to 15% interest, could be higher. So, if someone who's going to put their funds into a venture capital, fund, why are they deciding to put some allocation into that? And what type of return? I mean, everyone hopes for 100x return, but
That's right.
for people who may not understand this, people or institutions or endowments, pension funds are putting a portion of their resources into these funds. What is the hope in terms of return, like that they might get, X number versus if they just left it in a bank or, let's say, real estate or bonds?
That's right. Yes. So basically, the asset class is riskier, so they hope for higher returns, right? And for diversification. So, I mean, this gets into portfolio allocation, right, which is a whole different topic. But essentially, if you can think about it like your 401k.
Mm-hmm.
It's simple. You want to have money in different places. Why? Because you're hoping when one part of your portfolio goes down, the other part goes up. And you're taking different amounts of risk depending on your age, depending on how much money you're putting in, depending on the lifestyle you want to have after you retire, all of this. And institutional investors do something similar. And so with private equity and venture capital, the idea was it's not correlated with the other asset classes. So that's one big piece. And then also they're hoping for much higher returns. Whether or not, that's happened, we could have a whole different episode on that. But that was the original thought. And in the 80s, it was true. And the other reason why startups take venture as opposed to getting a loan is that some tech-based startups have a model where you need to capture a large portion of the market before you can turn a profit. So no bank is going to lend to you. Other startups can bootstrap and use debt, which is a bit more sustainable and you maintain ownership. But for the types of businesses where you really need to go out and get the market first, you need a lot of money for sales and marketing, and venture works much better.
And just two very quick stories. I mean, we do small scale angel investing, which is much tinier than venture. But we also, PCN as a social enterprise, we're tiny. Like, we sustain our operations. We're not going to grow exponentially. And we used to work out of this co-working incubator space, I won't say which one, in DC, with a lot of cool startups. And there was all sorts of experts and innovators and industrial food kitchen, like a treadmill. It was amazing. And and everyone, I would say, was not everyone, but the general assumption was success was getting investment or getting acquired. And we used to just say, we were tiny, compared to startups at 40, 50, 100 people. But we used to say, isn't enough just to survive? So that there is this, and only 1%, less than 1% of all startups get venture. So there, it's glorified a lot, but it is, there's a lot of, and then venture, let's say, the fund partners or the venture funds, there's all different mechanisms, often take 2% yearly fee, plus if there is an exit, 20%. So there's a lot of complications, but it could be super successful.
No, it is. I mean, and also the impact side of venture, impact venture funds actually tend to be debt. It works better for most of the social enterprises. There are very few impact venture funds that are truly equity only, and then there are whole conversations around that. But the venture model is challenging for everyone. It's challenging for the investors as well. I mean, if you're successful, you can make a lot of money, but when you're developing your track record, you're under tremendous pressure to prove to your investors that you know what you're doing. And if you're a smaller fund, I know it sounds crazy, but if you're under 100 million, sometimes the people who are working at those funds aren't even getting health insurance. So, I think when people hear these large numbers, it's tempting to think that, like, oh, they're just taking advantage of small businesses or startups. But the reality is they're often in startup mode themselves. That's different from Andreessen Horowitz or Sequoia, but the smaller funds, it's actually quite challenging.
So can you talk a little bit about, so we've been talking about finance, a little bit about impact, but what in the world is impact investing? And,
Oh no, Craig.
where would you situate yourself, in terms of this innovative finance? Do you call yourself someone who's focused on impact investing, or not that you have to label yourself, but
Well, it is helpful. Let's see. My career journey has been interesting because when I first started out, my 10-year goal was to raise my own fund. And I had no idea how difficult that was, first of all. But that was my goal. And then I switched into banking. And so originally I was really focused on impact investing. And I would say impact investing is, this one's tough. Okay, impact investing in the venture space, right, is using institutional money to fund social enterprises. So to fund startups and businesses that do something good in the world and that follow ESG principles in their businesses and also have a positive impact. Innovative finance is much broader and covers a much wider spectrum across both private markets and public markets. And when I started working at Standard Chartered Bank, I was a credit analyst, but I happened to be a credit analyst during a really interesting time because, number one, it was Trump's first term, so there was a lot of concern about the things that we're seeing happen now. There were concerns about that then, and I was covering most of these multilateral development banks, U.S. government entities, and sub-sovereigns, large NGOs. Everything that is happening now, there were fears about his first term. So that was one aspect. And then I was also a credit analyst during COVID. And the people that we were providing products to were very heavily exposed to emerging markets. And so that was another piece of my work. So I got very, very interested in sovereign debt because there was a lot of conversation happening around country level debt and restructuring and what that means for the businesses and entities that we were banking. But it also, for me, coming from the international affairs world, I was thinking really deeply about what does that mean for people's lives or for the longevity of these countries, like their budgets, what they can do for their people. And so that's where my career kind of became more complicated.
for people who may not know, can you define sovereign debt? And then the second question, describe a little bit like what is it? What did you do as a credit analyst? So did you spend all day in front of a computer? Were you going to conferences, talking to other government and private sector officials? Like, not that you have to boil down to one or two things, but I think it's hard for a lot of people to picture what does that mean on a daily basis.
Sure. And for me too, when I initially, I got that job out of a recommendation from my finance professor. But when I read the job description, I was utterly confused. I had no idea. I don't think they do a good job of writing job descriptions, to be honest. So what is sovereign debt? First of all, sovereign debt is simply the debt that countries issue, so U.S. treasuries, to fund their expenditures. So governments get revenue, right, in taxes and fees and other things. but they also sometimes need to spend money in advance. And how do they do that? I mean, I'm really simplifying it here, but I hope that's okay. They issue debt on the public markets, and then institutional investors buy that debt, and so that gives them cash. I mean, it's kind of like a loan for a country. We just call it a bond. It is more complicated than a loan, but for our intents and purposes, that's essentially what it is. And many countries issue them. You kind of have to be at a certain financial stage of maturity and have good governance, or else the buyers on the market will not buy your debt, or it will be so expensive that the interest rate on that debt will be so high that it's not worth your time to issue it. But in the past 15, 20 years, a lot more emerging markets countries have issued debt to fund their budgets. Is that good?
And then in terms of credit analyst, so whether it's thinking back to when you were working that position or what you envision it is today. So again, is it, I can't stand the guy. I won't go. There's some people on finance TV shows. I won't say which one. It's like, and they're just stressed and screaming all the time. It's more like, for individual traders, but is it like you're not sitting, on Wall Street trying to execute rapid trades for yourself or the fund or your clients, but like, what does it mean? Is it analytical? Is it all statistical? How much are you out of the office?
Yeah, that's a good question. I think it probably differs a lot by bank or by financial institution, because there are credit analysts in many different types of financial institutions. But at a large commercial bank, our job was, first of all, the hours are pretty standard, which is unusual in finance and quite nice. It's an analytical job, but depending on what portfolio you're covering, you're probably including a lot of qualitative factors like the market growth, and you're watching geopolitical factors, particularly if you're working around emerging markets. So most of the time I was, especially during COVID, but I mean, we had trainings, theoretically and ideally we were supposed to be visiting clients, but that never actually did come through, in part because I just had 1 year before COVID hit, and then the last 2 years were during COVID. But you're sitting at a desk and you're looking at the client that you've banked, the products that you're offering them, and the current market conditions. And then you're trying to explain to everyone on the team, to the bankers who are selling the products, to the credit people who have to approve it and are watching the overall limits at the bank for the risk limits. You're basically telling them whether or not you think it's a good idea and why. And also things to watch out for, right? Like, okay, we can bank this client right now, no problem. We think they're going to be, their revenues are going to be stable. They're going to be in great financial condition. However, we need to watch X, Y, and Z for the next time. And it usually happens on an annual basis. But if a big event like COVID happens and there are concerns about the portfolio starting to get stressed, or if there are big funding changes, like at the UN or the World Bank, then you do ad hoc stress testing of the portfolio. I did try and make it more quantitative. It's both quantitative and qualitative, but I think there's a lot of opportunity to do deep quantitative analysis on portfolios. Yep.
And so let's say someone is listening to this now or in the future, or friends you've talked to, and they would like to find some type of role around innovative finance. Are there any core skills that, I mean, obviously there's lots of roles. It can be admin, it can be finance, it can be marketing, but any core skills or knowledge that you would say for people who want to work around this area or in it, these are some skills that have been important or likely to become important?
Yes, it's such a difficult question, because I think when you're looking at any job in impact finance, which covers impact investing, innovative finance, having some traditional finance in whatever specific field you're looking at, whether that's venture capital or emerging markets fixed income, it is helpful to have, I would say, between 3 to 5 years in that space, to get a grounding and a foundation and a knowledge base. But then for innovative finance or impact investing, where you're working with novel structures, you're often working in emerging markets that have different contexts, then I think you need to also have field experience.
Mhm.
So you really need to get out in the field and understand what the actual market conditions are like. And we're seeing it now with the US, but a big piece of this is understanding the geopolitical space that you're operating in, because that leads to risk. And
Mhm.
my finance professor said, and I found this to be true, all finance is about risk. Why? Because when you're working with money, in general, ultimately the goal is not to lose it and to earn more of it, right? So,
Mhm.
so you're always watching the risk, and even when you're working in impact finance, you still want to know the risks. And I think the good thing is it's more trust based. So actually, the risk ends up a lot of times being much lower than what you would anticipate from a traditional finance lens. But yeah, I would say get some grounding in whatever type of finance you want to be in, hopefully in a traditional space, and then get some grounding in the geopolitical, footprint, and then you can combine it.
And do you see, obviously, some sectors because of U.S. policy, not just U.S., but a big degree U.S. and tariffs and all sorts of other things are going to be contracting. So if you're thinking about innovative
Mhm.
finance, I mean, a fair number of people, including myself, would say climate. I mean, different parts, not
Yep.
all parts. AI type things. But do you see any
Yep.
where the capital is going to be moving, like what are the sectors, again, this is not, we're not quoting you, and if someone comes
Yeah,
back
no,
in
that's
5 years,
okay.
but what are the
Uh,
sectors that you think are more likely to grow where different types of investment capital is needed?
hmm. Yes, that's such an interesting question. The real answer is I have no idea. And it depends what you're talking about, right? Like it depends if you're talking more about development finance abroad versus domestic impact finance. I think there's a really, in the US, there's a very, very strong movement, um, piloted primarily, I believe, by Pete Stavros at KKR towards
Mhm.
employee ownership. And I see that really taking off. And I think that's very positive. I don't think that that's going to slow down. When you're talking about development finance and working abroad, I think one area that will remain strong is agricultural finance because, again, that's a space that is constant. Everyone needs to eat, all countries need to fund their farmers. And so I think that's a relatively safer space that most people will be interested in. And it's also a space that incorporates a lot of climate work but without saying it. And so that keeps it a little safer as well. Climate finance and actually nature finance. I think nature finance is going to take off. How, why, that's a different question. You see BlackRock and some of these big asset managers making very fast moves in this space. Is it because they are working from the impact angle, or is it because they're concerned about resources? I mean, I would guess it's because they see that these resources are going to be constrained, and anytime you have scarcity you have an opportunity to make money. But I do think that nature finance will continue to grow, which seems really odd given the circumstances. But I would say nature finance, ag finance, employee ownership in the US, those three seem to be well situated.
Okay. Yeah, Ownership Works is a great organization that
That's
sometimes is
right.
hiring, that's doing a lot of research and practice and advising in this area.
That's
To
right. And
think
that was
about,
started by Pete Stavros,
yeah,
actually.
so
Yeah, as you know. Yep. And I think Colorado is also doing a lot of work in this space right now. So if you're looking for jobs, it's a good
mhm.
place to look.
So a kind of a bigger picture question. So there is more. We were talking before the podcast started. So there is, the global GDP is like 85, 90 trillion. I mean, it's going to contract this year, but there is enough, and the estimates for achieving the SDGs, which we are so far away from. Like we didn't achieve the MDGs, Millennium Development Goals, and
No.
the estimate is like we need 2 to 3 trillion a year, both in private and public investment. So there is enough money in the world to, I won't say solve the challenges, but address the challenges.
Yep.
But the how money is allocated is moving further away, in my opinion, and lots of experts from addressing clean water education, health, sustainability. So what are your thoughts that so much of financial equity still, despite all the discourse, is motivated by profit without factoring in the true human and planetary cost? Like, it's very rare. I mean, there's all these things around carbon offsets. Most of them are a joke, or very, like, they're not adequate. So there's very few companies in the world, like this little mug, it's from a local, city in Colombia, but like very few companies are thinking about sourcing and transparency from the product or service through the use, through the end of life. So just, what are your thoughts about being within a system? And I do investing, so I'm part of this, but this kind of paradox of like, we need capital to keep the world dynamic and flowing and investment, but we're just not putting much of it into the areas it really needs to go.
Yes. Yeah, it's difficult. I mean, the first thing that came to mind was political risk, or just risk in general, right? I mean, if you don't distribute capital more equitably, over time that develops into political risk. And you can see this throughout history. So if you ignore people, if you ignore problems, what happens? I mean, there are revolutions, there's war, there's conflict. I mean, I think this is pretty clear. And sometimes it takes that. And same with the resources, right? What happens? I mean, somebody can turn a profit from it, and they might, but you start having a lot of, one of the things that's been predicted from like climate disruption is internal displacement in the US. And we're starting to see that. And, not being able to insure homes in huge parts of the US. I mean, these are issues that eventually become really serious. And I think it's a case where it's like an ounce of prevention is worth a pound of cure type of situation. But sometimes it has to develop, like the risk has to materialize. One thing I will say is one thing I found interesting about my time in commercial banking, which was admittedly very limited, I was only there for 3 years, is that once a model is proven out, or once a concern is taken seriously, or once there's an opportunity like a market opportunity, things change so fast. When I first got hired, I sat in a room full of 50 people, and somebody asked if anybody knew what the UN SDGs were. And I think I was the only person in that room. But a year later, they were launching a sustainable finance division, and all of the marketing materials, at the bank were around sustainable finance. And so I think once something gets proven out, and you see this happening with nature finance right now in traditional finance spaces, it's moving super fast. So I think that's a positive. But in terms of the overall structure, you either have luminaries who are piloting models and proving them out, like Pete Stavros, who are well respected in their fields, who are really pushing the conversation forward, or the risk materializes and then things shift quickly. But you and I both know, I mean, it's an issue, it's a problem.
Yeah, I mean, I have a friend, I won't say, in a coastal state that I visit occasionally, or we visit, and their house insurance is probably more than their mortgage now per year, if they can get it. And
Right.
that is like a lot of there's a lot of, I mean, the Trump administration, let's just exploit,
Yeah.
and maximize profit without thinking about, or not thinking, but just ignoring. So a couple of more questions, and again, if anybody has questions on the call, feel free to put them in the chat. So for people, I teach on social impact investing, and so one of the things that I find, and was a full-time professor for 10 years, taught on this, I find many people who are not in your area, in the finance area, but many people in impact in general, connected to SDGs, often don't really like to think about, I mean, some people are fundraisers, but many people don't want to think about their own relationship with money. And there's a lot of research that shows how people choose to park, save, and invest, or organizations, can have a huge impact on the world, both in terms of ensuring things don't get worse, but actually going towards pro-climate solutions. And, for example, I'm involved with Carbon Collective. I think it's, as an investor and also a scout, I think it's one of the best companies in the world for organizations or individuals to move retirement accounts or individual accounts. Not perfect. You always have to make your own financial decisions. Or we're probably going to have the head of the Global Alliance for Banking on Values. I think they might be on our podcast this year. So it's a network of banks that have committed to triple bottom line. So when you're an expert on finance, and when friends talk to you and say, like, how do I ensure whether it's $500 or $100,000 or $1 million, they want to have some return, but also make sure it's not financing prisons, pollution, pornography, war. Like, what is your thoughts? Again, everyone make their own decisions, but how people can make better financial decisions around these issues personally or for a small organization?
Greg, I'm going to send them to you. So this is my dirty little secret. Like, I love finance. I love kind of the esoteric parts of finance, but personal investing is something I have to force myself to do. I mean, not to save the money, but to go in and think about how to allocate it and how to do that well is something I actually really dislike. So something I've been thinking a lot about lately is going to an advisor who is an expert in this for individuals, because it's different, right? At the institutional level, I understand it well. I think it's interesting. I can do it. But at an individual retirement level, it is a lot more complicated. And so I think, to your point, like finding, entities like Carbon Collective or individual financial advisors who can support that is great. And something that I'm actually currently considering myself, because it can be so overwhelming. Yeah, that's
Okay.
my advice.
And just to say, in my research and teaching, I would say 97% of all the investments that are classified as, whether it's environmental social governance or social responsible investing, in my opinion, they're horrible. And and it's like they might be good on one thing. So there's a lot of indices. You can look at MSCI or JustWorks, but they're good on one thing, like maybe on diversity, but their products fundamentally destroying the planet. So it's really, there are some, particularly in the public markets, but looking for organizations that don't just say it. But if you have the time, look at the portfolios, because like even in Vanguard, where I used to have some retirement, I would look at their FTSE, social responsible, and I would look through them, like, not any of. I mean, maybe some companies are not bad, but most of them, like, this has nothing to do with social impact. But that's one of the challenges. So a couple of more questions. You talked towards the beginning of how you see finance or innovative finance changing. And again, this is not, I'm not going to come back in 10 years, but just considering both AI and just where things are going in the world, do you cite others where you think things might go? So is investment, I mean, I'll tell a short story, so I won't go into a lot of detail, but I was facilitating a section of an AI course the past 3 or 4 months. And there was someone from finance in that course, and we had a lot of discussions about what AI could already do for that role and where it's going. So just, what do you see in terms of how things might change?
I actually feel pretty positive about AI for finance. I think it could be a really good tool to help collate more market signals and give better predictions, because we all know humans are actually very bad at predicting. That's a skill set that we've never been good at. And when you watch the markets move, one thing that really surprised me about finance is that it's very driven by group mentality. Why? Because if you're wrong, you don't want to be left out in the cold. If you're a trader, you will lose your job and your entire career. If you're a banker, you might also lose your job. I mean, all the metrics, if you're on the front line, are about making money. And so I think I hope that AI can incorporate more unusual sources of data to provide better information about risk. Also for things, one big topic, sorry, this is kind of slightly off topic, but one big topic in sovereign credit is around, and has been for a long time, is like, are the African sovereigns fairly assessed? Like, that's a big that would make a huge difference. I don't know the answer to that, but I think if you have better data, I'm a finance person, I'm a numbers person. I think having more data is really important, and I think you do still need the human element because you need to incorporate like geopolitical human components to the analysis. But I think it can make things more accurate, similar to how it's improving accuracy and diagnoses for medicine.
Mhm.
That doesn't make doctors worse, it makes them better,
Mhm.
you know?
Okay.
So, yeah,
Yeah, so the World Bank meetings just happened or happening,
are
and
happening.
there's a lot of discussion as you're talking about the African sovereign debt that a lot of countries are spending more in servicing, paying their debt payments than they are in, social good or education infrastructure. And so are you aware that, let's say, if it's 54, 56 countries in Africa, so the interest that they're charged for sovereign debt tends to be higher than other regions?
Yes, that's
Yes.
right. Hmm.
And I'm probably older than you and other people listening. I remember when there was the Jubilee campaign. I think it was around 2000. Like, of
Hmm.
let's I forgive debt because
Yep.
the debt is such a burden to social progress. And are you aware of? I mean, some people are still saying it, but I don't see that same large scale movement of like 20, 25 years ago.
Yeah, and economic growth. It exists. The Jubilee campaign still exists. I think actually it's supported by research. So Carmen Reinhardt is a leader in this field. And one of the papers that she did, I think with Kenneth Rogoff, but I'm not
Mm-hmm.
totally sure. And you can chat GPT this to find the source. But one of the papers that they did showed, and you can see this with the Brady bonds in the 80s, is that if a country is really debt distressed and you just kind of keep kicking the can down the road, it doesn't prevent the need for debt forgiveness. Eventually, most of the time, some of the debt has to be forgiven in
Mm-hmm.
order for the country to get out from under it. It just slows growth.
Mm-hmm.
And that's bad for everyone, right? And we understand in the US, we intuitively understand this. I think it's part of why we have such a strong economy, because we actually have strong both personal and business bankruptcy laws. It's the same principle, just at a sovereign, at a country level. And especially for emerging markets, not all the time, but sometimes it's not their fault, right?
Mm-hmm.
Currency fluctuations, like the strength of the dollar, all of that can cause massive disruptions. We saw this in COVID, which is why I thought it was so unfortunate that that as an international community, we hadn't done more continued work on sovereign debt, because that wasn't their fault, but they were really feeling the effects of it. So I think having some bankruptcy proceedings for sovereigns is quite important.
Can you talk about thinking about economics or finance? Are there any there's not that many new ideas or burgeoning ideas that most excite you, that maybe whether it's in policy or just academia and theoretical around kind of, some people are talking about degrowth, which I haven't seen much around degrowth and kind of investment, or, you talked about natural capital. So anything that, or several things that might be interesting you that are kind of up and coming.
Yes, I mean, I love, thematic bonds, sustainability linked bonds. I think are a very interesting space. I don't think they're going to solve anything, but I find it interesting. I of course like stay up to date and read extensively on sovereign debt law. That's a space that's esoteric and small and niche, but really, if things change in a positive direction, has it will have a lot of positive effects. I can't remember. I need to go back and reread it. So this is just a pin for everyone listening. Leo Strine, who is a judge in Delaware, has written really interesting things about capital markets and the way that he thinks they need to change in order to promote better societies. So I really like him as an author. I love Joseph Stiglitz, the Nobel Peace Prize winning economist,
Mm-hmm.
and his thoughts. And then I think employee ownership is great. I think it's a huge tool for growth and equity in the US and in other places. And revenue based financing as an
Mm-hmm.
alternative to venture capital. Those are things that I'm following and interested in.
Yeah, so all amazing things. I didn't know the judge. I'll look him up. And then just an example. And then there's also an interesting experiment by Eric, going blank on his last name, the founder of Lean Startup. He helped start Eric Rice. So he helped start the long-term stock exchange, or he helped co-create it. And the idea is it's still earlier stages, but the idea if US-based publicly traded companies can move away from quarterly reporting to long-term vision. So, there's a lot of, and then lots of interesting experiments going on there. And I will say, one of my favorite podcasts on finance is called Capital Isn't. It's out of University of Chicago. And it's, I think that there's a journalist, I think was the same first name as you, Bethany, and then a professor, Luigi. And they just deconstruct, like one's more pro-business and one's a little more critical, but they just do fascinating conversations on a lot of these issues. So two other things, and we'll start to wrap up. Where do you go? You talked about reading about sovereign debt law. So, let's not get that specific, but for people who are like, oh my gosh, this is so interesting, and I want to understand both the trends and opportunities and careers and research. Impact Alpha is a great resource for impact investing, but where else do you go, or do you find it on blogs? Are you reading obscure, 21st century treatises that are with small print? Like, where do you go? Where do you go to kind of, let's say, not too technical, but be inspired and informed?
Sure. I think, yes, like you mentioned, Impact Alpha is kind of the go-to. Financial Times Alphaville is also very interesting. They write really good research for a lay audience, but it is well done and you'll learn a lot. I love the Bloomberg Odd Lots podcast. It is not impact focused, but I think it's really important to understand things broadly. Oddly enough, one of my favorite jobs, and a job where I think I learned the most that has helped me in my career, including in the impact space, is when I did an oil and gas price forecasting job. I think understanding systems is really important. So read the Wall Street Journal, read the Financial Times, read Bloomberg, and then go read Impact Alpha and New Private Markets, Responsible Investor. Those are great sources. And the IMF World Bank blogs. And one thing I always do is if I find somebody whose posts I like or who I think has really interesting thoughts, I ask them what they read. So I have a very long reading list right now from that.
And then you are starting a Substack, or is it started? So feel free to do a little plug, like what's the focus? When's it launching? Who's it for?
Yes, I am almost there, Craig. Thank you so much. So it's basically, I'm just launching a paid subscription off the back of a jobs list I started after the USAID cuts for my grad school. And so many people reached out and said it was helpful that I thought, okay, I'll continue this, but I need to have it compensated to just have the motivation to keep going. So basically it's on global finance, impact investing, and innovation jobs. So it's very specific. I will be launching it, I believe, later today or tomorrow. Just a $5 a month subscription for a biweekly newsletter, which is a jobs list that I will include the location, the salary information, and I think the job title, the place, salary, and location. Yep.
So we'll put that in the show notes. If it launches by Friday, we could do it later. And then last two questions. So one, is there any TV show or movie that you think best reflects the reality of finance? There's all these ones that glorify it or demonize it. So is there anything that that is enjoyable to watch, but somewhat accurate?
That's really funny. Okay, I don't know how accurate this is because I've never been a trader, but it is a finance-related TV show, and it's called La Borsa. I love it because it's also about women in finance. So it's on Netflix, and it's about the first two women on the Kuwaiti Stock Exchange. I think it very well reflects the reality of being a woman in finance even today, and it does help people, I think, understand some of the basics. And then there was also that movie that had Meryl Streep in it about offshore finance. It's an old movie now, but that actually, if you want to understand offshore finance, is phenomenal. I just can't think of the name. Okay. So those are my two recommendations.
And then anything else you recommend in terms of upskilling for people who want to, because a lot of people shy away from finance, or some people, think it all involves X. So not to say if you endorse or mention a particular course or book that people should do their own research, but, is there any MOOCs or certificates or other places where someone's like, I really want to build, more expertise and knowledge in this area, places that you or others recommend or might go to?
So some of the big ones, which I think are, still relevant and relatively low cost. I mean, if you do the CFA, right? The CFA is mostly a public markets designation for traditional finance. It does cover some private markets, but that's a really good grounding for any type of allocator job. In institutional advising, or if you want to go into financial advising for individuals. You can also do a CAIA for alternatives if you want to go more into private markets. If you're looking at venture capital, VC University has a really good program that's coming up. And the last one is ICMA if you're looking at bonds. They have good programs for bonds.
Okay. What does ICMA stand for? International Capital. Oh, sorry, in this pop-up.
I think it's International Capital Markets Association.
Okay. And I'll put one more plug. There is a really good free course put on by Brad Feld, co-developed it, and it's Kauffman Foundation. And I took it. It's really good, and it's usually offered twice a year, cohort-based. And so for people, it's more on venture investing or founders, but you could spend a lot of money in it. Kauffman Foundation and somebody else. But if you look up Brad Feld, it's really good. I went through it a couple of years ago. And then the last thing, any other book, show, or movie has nothing to do with finance that you just is occupying your brain in a good way?
I read a lot. I love to read. But one thing I think for one book series that I love so much, and it's true, it's a true story, it's an incredible story, and it is particularly relevant and good for times of uncertainty, is the Salt Path trilogy.
Mm-hmm. Okay.
If you're facing tough times, you can't beat that trilogy. It's a uplifting story, and you have to read all 3 books and get to the end.
Okay. And then the last question, just for people, I mean, you're launching your newsletter, but is LinkedIn the best channel to stay engaged and see what you're working on and sharing, or anywhere else?
Yes, I would say for now, LinkedIn. I'm rebranding my consultancy one more time. Okay. So it'll be called Rain Advisory, and the web address is rainadvisory.co. But that's another thing on my list to get the website finished and up and running in the next couple of weeks. So for now, please, feel free to follow me on LinkedIn, follow the Rain Advisory Co page, and stay tuned for more.
Thank you so much for all you do and taking time to demystify what could be complex products. I feel like maybe you could have your own YouTube channel. I'm not trying to create it for you, and just be like, sovereign debt, but make it fun, things like that. So, because there's a lot of personal finance channels, but there's not that many for kind of demystifying more systems level things. So anyway, so this will be, as we started off with, please follow Bethany. Please check out the 180 plus other episodes. Consider rating it. Stay tuned. We have lots more guests coming up for season 14, and have a wonderful afternoon.